Hi, everyone. Thanks so much for joining us today for this much anticipated webinar. I'm Christine Tsai, CEO and founding partner at 500 Startups. I'm excited to be here today with Ken Lin, CEO and co-founder of Credit Karma. Credit Karma's mission, and Ken definitely correct me if this has been updated in any way, but Credit Karma's mission is to make financial progress possible for everyone and also redefine the entire marketplace. Credit Karma is also a 500 portfolio company. I'm looking forward to this conversation and hearing from Ken his advice for founders and CEOs navigating through COVID, as well as his learnings and experience from building the company during another crisis back in the 2008 era. Also, as we're seeing very rapidly with the impact of COVID on consumer behavior and sectors and all around the world, we'll talk to Ken about his own insights on what he sees as the biggest problems and opportunities in FinTech now and post-COVID, particularly what's going to be the most pressing needs, and also like how entrepreneurs can serve those needs and have an impact. All right, so Ken, maybe to kick things off, it'd be great to have you just briefly speak to the story of founding Credit Karma back in, was it 2006, 2007, and where it got to today. If you can, if you can do the high level overview.
Yeah, sure. So first, thanks for having me here. Pleasure to speak in front of everyone and just kind of share a little bit of our experiences. So just as background, I started my career in the credit card space and I've always been a little bit of a serial entrepreneurial. And the backdrop is I moved, to the Bay Area in 2004. And I remember just having lived in Boston for a while after college, I realized just the fundamental difference in the opportunity out here in terms of the community, sort of the funding scenario, just the generalized entrepreneurship. And with that, I came out here and I worked for a company called Elon, which helped on the mortgages, auto lending, and generally mortgage refinances. And I remember doing a lot of marketing and realizing that there was a big opportunity that around helping financial services companies find the right type of customers. So sort of noodled on the idea for the better part of 2 or 3 years and decided to start the company in 2007. We kept our head down. We were in stealth, launched in 2008. And, before we knew it, the financial crisis happened, right? And so, it sort of went from a two-year period of thinking about the idea generation, 1 year period of just working hard and getting the product established. And then, I think launched pretty well. I have a couple of funny stories I'll share a little bit later about, some of the sort of the highs and lows of being in a startup and the sort of the feelings and jubilation and the despair that you feel along the way. But it started in 2008, so we certainly saw a lot of the downturn. We saw, I think at one point we had maybe 30, 40 partners in terms of advertising partners, and that, went down to one, and that one partner was Advanta, and they subsequently went bankrupt like 3 weeks later. So, it gives you a sense of the environment, and to your point, it very much mirrors some of the trends that you see today. But, certainly it was an interesting journey in 2008, and, I think we learned a lot from that, and, we're trying to apply today.
And today the company is how many people?
So we're roughly 1,300 people. We're across, 5 offices now. For the most part, we're still a product and engineering led organization, and we have, roughly 100 and getting close to 110 million members across the world, and most of those being primarily in North America.
Got it. I'm sure you probably get this question a lot, and it's so hard to compare and contrast different crises because they're so different. But what do you see in terms of if any similarities between the experience in 2008 and what's going on right now?
Yeah, I was thinking about this the other day on a run, and I feel like every 10 years or so, everyone calls it a black swan, and it's something that'll never happen again. But I guess having lived through a few of these, and I was, we're winding through history, these macro level shocks do tend to come, and I would note that they probably always come in a form that you don't really expect. Right? In 2008, it was basically the banks becoming insolvent and a mortgage crisis, and in 60, 70 years of history, we'd never seen a year-over-year decline in real estate prices, residential real, and that happened, right? And here, they have a pandemic that no one really saw. And then there was the dot-com bubble before that. There's deflation in the 80s. There was the oil crisis in the 70s. So what I noted is that we all call them black swan events, and they are because they come from a direction that we don't expect. But, I was thinking a little bit more about it. And to me, regardless of how it comes at you, the fundamentals have to stay the same in terms of the way that you run a business. And maybe it's, I can tell a little bit of a story of how we oriented around this. I remember, I started my career in the late 90s, and I was definitely, my second job out of school was, in the dot-com days. And I worked for a credit card company first, but my second job was in the tech company, in the tech world in Boston. I remember joining a company that was going to go public maybe three months after I joined. So it was crazy. I went from basically a bank job to one where video games everywhere, unlimited fridges, free dinner every night, and, a lot of the things that we still have today. And I remember that, I was, my second job. So, really junior, very little experience. One, I remember how awesome it was in terms of the friendships, relationships, how much I enjoyed work. And those are things I still carry with me today in terms of the way I think about building Credit Karma. But the other thing that really stuck with me was really the lack of discipline around financials in terms of building sustainable businesses. And one of the funnier stories that I remember was, so this company, went public. I think we priced at $17 a share. We had a refrigerator where everyone would put what they thought the opening bid was going to be. And I remember that range was like up to $350, right? You priced 17 and people thought it was going to go to 350. And by the way, that number was not crazy, because if you remember those days, like that happened all the time. Things would price at $25 and shoot up to $200-300. So that was the mindset of everyone. But I got, I remember this note and someone telling me, so we were in one of these office parks that were like, 4 floors and had a centralized common area. You could take the elevators to each floor, and you'd go into the common area to take the elevator, or you take the common area stairs. And I remember at one point, the company decided that it was too inefficient for us to walk into the common area, take the elevator or the stairs up to the second floor. So they cut through the concrete to build a custom stairwell between the 2 floors. And this is like, some random office park in the middle of like Woburn, Massachusetts. And it was $2 million. And the company was making $4 million a year. And it was just about to go public. And they spent $2 million of that on a stairwell. And I just remember, like, that seems kind of crazy. And in hindsight, it was crazy, right? Because we as a company priced at, it was 17 at the opening. First trade was $51, $52. So everyone was, pretty much a millionaire on paper. And that was the highest it basically ever got. And it rode itself all the way down to about $2, right? So quite the ride. I learned a ton about running a business, about being disciplined. And it gets back to the original question, which is, what are the commonalities of all these crises? The commonalities, you got to be smart about how you manage your money. And we certainly didn't see 2008, 2009. The good news is, having gone through 2000, I learned that, hey, $2 million stairwells are probably not the way to build a good business long term. And it's always stuck with me in the back of my mind through every cycle, good or bad, in terms of how we manage. And I think it's helped us in many ways.
Yeah, that's it must have been very. I wonder how much value they got out of that stairwell, or did they completed the construction?
Yeah, they got the stairwell done well in advance of the IPO. And back in those days, people were just handing out money left and right from the VC community, and this is, had the dot-com bubble, and profitability didn't matter. And I think the industry has gotten a lot better in terms of what's acceptable, what's not acceptable. And I don't know if we would have weathered this, or we would have weathered any of the other storms had we not gotten to that place. But I would just note that at every instance, there's a learning opportunity. And the commonality, again, here is, you have to really think about, as a founder, CEO, what are you going to do with those dollars and how to use it in the most cost-effective way?
Yeah, definitely seeing a lot of that where, with 2000, I remember that coming out of college around that time, in the dot-com, like one summer, it being just very, a lot of .coms just hiring like all over the place. And then the next summer it was just like desolate, and just how stark it was. And then 2008 as well. It's, I mean, seeing what our companies are going through now, it's definitely favors those who've been very mindful about how they spent, and really focusing on their business model. But I remember, I think this was a time when maybe you spoke at 500 a while back to one of our batches, but I remember you told some stories about how, as the recession dragged on in 2008, Credit Karma nearly ran out of money like several times, and just going through that. And I guess like in that experience, it seems like, so far, so long ago, but what helped your company during those times? And I think you mentioned one of it, just in terms of being very disciplined about finances as a CEO, and mindful of those decisions. But anything else that really helped get you through three near death experiences?
Yeah. Well, yeah, and I think that's that note. I mean, I think the count is something like 5 or 6 times that we've almost gone out of the business. So that was either, I had to write another check with like the last of my savings, or we had to have a bridge loan, or whatever it might have been. But just to give you a little bit more of a backdrop in my philosophy on this is that, we've raised, I can't remember the exact amount now, but roughly $500,000 through an angel round, friends and family. And it's actually relatively easy in the sense that there was an idea, and this was in 2007, so before the economy really crashed. But, so notice, we launched the product. I think it went relatively well in the sense that we got good users, good press, and things were kind of going along. And then all of a sudden, as like now, sort of the floor fell out from underneath you, and that all banks, back then were like, they might be insolvent. So all marketing dollars stopped. The economy came to a halt in many ways. And again, a lot of parallels to today. And, we had planned well, and that $500,000 that we had already lasted us, maybe a year and a half into development. And we felt pretty good. And we'd always think that, that there's a Series A, and I think this is a little bit of a bias that happens in this space, is that you'll read TechCrunch, you'll read Bloomberg, you'll read these articles, and you'll note that like, oh, it's so easy, right? The path is, you just go out and you raise an angel fund, and then like a Series A at 5 million, and you a $25 million valuation, and the B's right around. And I think in that is a lot of confirmation bias or selection bias associated with it, because for every one of those articles that you read, there's probably 99, if not more, companies that didn't get to that stage, right? Sort of failed the stage prior, and I'm sure you guys have all that data. So, that was my mentality going into it. It's like, oh, that's the process. We're on the process. And I remember how hard it was to raise money back in 2008. And we were starting to hit that inflection point of running out of money. And I remember, one, that like we felt really good about the product. We felt like we had product market fit. We felt like we had something that consumers really liked. And we had early traction, and that banks were advertising, but then they all stopped. And I went on probably a tear of maybe like 50 pitches. Like I feel like I've met everyone in Sandhill during that period, in that probably 6-month period. And it came to a realization that we weren't going to be able to raise money in that environment. One, FinTech didn't exist as a category back in 2008, 2009. But moreover, the venture capitalists didn't know anything about it, and they were just staying away from anything that had to do with finances, given what was going on in the greater economy. And there was this moment where I realized like, we're not going to be able to raise money, and the question was, what are you going to do in that world? And at many points we thought we were going to go out of business. And this one in particular, we really focused on, okay, well, what does it really mean to stay in the business? And we realized that, well, we're not going to be able to raise money from a traditional, so kind of went to the old friends and family playbook, and I think we ended up raising maybe $250,000 through just friends and just like, hey, we got something here, but we just really need to raise money and get us through. But the most important thing is we really hunkered down, and I think this is still paying dividends today. And I would bet there's a couple, 3 lessons here. One is a focus on the product, right? When there aren't people advertising, you just got to always focus on the product, and that's what we did. We realized there was no one who was going to pay us from a revenue perspective. But we said, you know what? If we're going to go out, we're going to go out in the blaze of glory. We're going to build the best damn product we know how to. So for about a year and a half, we just put our heads down and we just focused on building the best product that we could. Two is this notion of managing expenses. I mean, we were 5 people, I think, for the first 3.5 years, roughly, of Credit Karma's history. And, that's a really small team. It's a really scrappy team. But you can learn to adapt and adjust in ways that you normally couldn't outside of that environment. And that was the other thing we did, was we really decided that, hey, build a great product. We're going to really manage our expenses. We're just going to operate day in and day out. And then the last thing is not to betray your ideals and your principles. And this is the one that I think has the dividends today, which is, in all of the instances where we almost went out of business, I always reflect on, well, we're starting to build a large user base. We've got email addresses. We've got a lot of really interesting financial data. And, there's always this temptation to well, maybe you just send a little bit more email. Maybe you sell the data, in a legal way so that you can generate the revenue. And I think at all points in time, we resisted those ideas. And we said, we'd rather go out of business than betray those principles. And I think that has led to, the brand that we have today. That has led to the way that we operate. It has led to the trust that we have with our overall users. And in the darkest of times, where you have the largest temptation to do the things that, you didn't want to do in the beginning, that's where it really matters. And for us, I think we are better for it. And I think you'll, as a founder, entrepreneur, you'll always have, if not one, a dozen of those moments where you really have to think through, what do you believe in? I think that's really important. And we certainly practiced and learned all of those lessons in many ways the hard way throughout the course of those 2 or 3 years and over the course of the last 13 years that we've operated this business.
Yeah, I think what definitely strikes me just about Credit Karma, that it's differentiated from a lot of not just fintech companies, but a lot of companies, is the fact that the company is quite mission driven, and you call your employees Karmanauts, and have strong values. And you just mentioned there, in terms of really keeping those values and principles, even when it's sometimes the hardest thing to do. And it actually makes me think about, in terms of leadership styles. I think you shared with me yesterday, your Enneagram type is a type 9 with a 1 wing. So probably not what many people would think of as the quote typical leader, CEO. I mean, I myself included as a type 6. A lot of times people think of the type 3s or type 7s, but I'm curious, going through tough times, and even now, how do you feel like that's proven maybe to be an advantage, or even blind spots as you lead the company to make decisions?
Yeah, I think that in many ways, and this is a lesson that I learned along the way, that companies tend to mimic the personalities, characteristics of their founder CEOs. And I think that, one, that didn't occur to me for a long time. So the more that you know about yourself, I think the more important, you'll kind of understand it and see in the way that you operate. I tend to be a consensus builder, so I tend to like to listen to all points of views. I like to have a conversation, but I like general agreement, and that's the way I've operated. I think it's served us well in the way that we focus on the community of both members as well as our partners, as well as the employee base. And I think that balance is really important to me, and I think it comes out a little bit of my personality type. But I think more of the general fundamental, I think for founders is, one, recognizing what that type is, what your personality is. Two, realizing that's what's ultimately going to play out in the culture of a company. And three, I think you should embrace it and you should be authentic around it. What I find a lot is that founder CEOs will sort of have an ideal of what they want their company to be, but in terms of culture. But if they're not that person, if they're not that style, right? If that's not their style of leadership, if that's not their style of personality, it really falls apart, right? And you can hold the bus together for a little bit, in the sense that, you can project what you want it to be for the first 50, 100 employees. But at some point, when you're not having all those interactions, when you sort of have to let the company grow more organically, those things tend to fall apart if that's not who you really are. So I think the note for everyone on the call might be, realize who it is, be authentic, embrace it, and just realize that's sort of the outcome. And then, I think then try to leverage it in the best possible way, in terms of realizing and being authentic and true to who you are, and managing and being very upfront with the company. This is the style of company that we have, and this is how we're going to operate.
Great, great. So switching gears a bit, I'm kind of looking at the industry. So FinTech, I think probably back when Credit Karma started, FinTech wasn't, I don't even know if that term was coined, because I think, remember in the early days of 500, that FinTech, that word didn't exist. I think when we invested in companies, it was financial services or payments, because payments was kind of the predominant, company being formed. But, in the last, decade, there's obviously been quite a lot of investment into fintech companies from venture capital, as well as just general growth in the industry. I think, there's a Forbes article mentioned that just global investment in fintech companies increased more than 5,600% from 2008 to now. So going from like $1 billion to now 69 billion. And the amount that fintech companies in the United States alone has raised, raised quite a bit of capital as well. I think like 12.4 billion just in the last couple of years, and that's like 40% increase. And so obviously, when you see that much capital and innovation happening in the market, you would think that the entire industry is changing quite a lot. But I think you'll probably have different perspectives in terms of the startups versus the incumbents, who are much in any industry, but maybe in fintech particular, slower to move. And I know you've obviously had your experience over the years, probably interacting with these incumbents, and now with the acquisition that was announced today. But I'm curious, like, as with banks or just more established financial institutions, do you see this as a turning point in terms of there being them kind of having more of an incentive or more urgency to move quicker, or do you feel like there's still a ways to go? And does COVID accelerate that? Is there kind of a forced innovation? Because we're certainly seeing things on the healthcare side that we never thought would happen, and now they're suddenly forced to innovate and moving quickly to adopt solutions.
Yeah, I mean, I think in the fintech space, I think there's a couple of trends that have happened that are, and many that are still playing out. First, if you look at, I think, I can't remember what the number is, but if you look at sort of the market cap of the large global financial services companies, it's something like $11 trillion, right? And I think it's maybe the top 25 or something like that. And when you think about it, the question is like, well, how many of those will persist 20 years from now? And the answer is probably like, well, even if a majority hang on, there will be some number of, multi-hundred-billion-dollar market cap companies that will be new incumbent or new players to that rank. And I think that's the opportunity. And I think that's, why you see so much investment in the space. In terms of innovation and speed and disruption, I mean, I think the one thing is, because they have been so large and so profitable and so hard to disintermediate, it tends to move at a very slow pace, right? And I think if you look across the spectrum, I mean, there are very few, scaled, technology providers in the space that are in financial services over the last, let's say, even 10 or 20 years. And I think that's the challenge for consumers and the challenge for innovation is that when you're that large and that profitable, you don't necessarily have the incentive. And a lot of times they're tied down in focusing on compliance, on sort of just running the business, and that's fine. But I do think over the next 20 years, you'll see a lot more innovation. You'll see more consumers being the impetus for change. And I think, that's one of the things that we recognize in the space is that as we got to 25, 50, 100 million members, the sheer mass of their users and the things that we were trying to do from an industry perspective it's never easy, but it became a little easier because we had a lot of users on our platform. And I think that's the trend. I think that's the opportunity. And I do think that, millennials in particular, well, I'll stop using that term, but sort of like the next generation of consumers, when they think about, well, why is there one bank account? And, why are all these products not very competitive? And why is everything so complicated? And, I always kind of talk about, I don't think Uber or Lyft were particularly innovative in sort of, ride share. I thought the experience was what really got people involved, like the magical experience of like, I can push a button, the car shows up, I can get to the destination that I want. It wasn't the fact that they figured out that, Christine could drive me or I could drive Christine around like that. I don't think that was particularly like that was helpful in it, but ultimately it was the experience that drove it. And I think consumers are asking for like, why does this experience exist? And I think that'll be the force of change in fintech over the course of the next 20 years. Consumers realizing like, it doesn't matter that I have one primary checking account, or why do I have one primary checking account? And why are all these systems so disparate? And why isn't it magical like so many other communications, transportation, e-commerce platforms? Why is FinTech so antiquated? Right? I mean, what's the most interesting thing that's come out of FinTech in the last 20 years, right? The ATM, scanning my check over my phone, right? Like, it's cool, but like if that's the tip of innovation, it's not that compelling. And I think a lot more will come.
Yeah. And I guess now, like in terms of, now, COVID is upon us, and it's, and we're seeing a lot of attention on certain sectors, or, certain types of innovation. And curious, like maybe looking at it less from the, what sectors are top of mind or what will be long lasting. But I actually like to look at it also from a different perspective, more in terms of what are the needs of consumers. Sometimes they overlap, but just looking at what the needs are of consumers, specific demographics, what they're suffering from now, and what will likely happen post-COVID, and what's really top of mind. And just thinking of Credit Karma's mission to make financial progress possible for everyone and accessible. I'm be helpful to hear from you just what you see just from your own experience with Credit Karma's users, what's been top of mind. I think certainly for large swath of people, particularly in the US, is unemployment, having lack of income, just making ends meet. But I guess specifically for Credit Karma, there's probably some questions on credit score impact, especially with rent and mortgage and loans being deferred, as well as just kind of what this means, if we can even think about a post-COVID era, or post something, like what they should be preparing for.
Yeah, well, I think if you look at, we've been talking a lot about this need for emergency funds, and I think if nothing else, COVID has pointed out that, sort of the frailty and how fragile, we all are from a finance perspective, and the typical consumer, right? Half of Americans don't have $400 in a savings account. A quarter of Americans live paycheck to paycheck. And when you see something like COVID happen, you realize just, how much of an edge everyone is on in terms of success and failure. And this has really highlighted that from a consumer perspective. And I think from an industry and an economy perspective, a few things have, I think, come to focus a little bit more. One is, I think, the general importance of the financial services sector, credit, the consumer's use around it. I think those are all important things. The economy wouldn't work without it. But at the same time, I think this crisis has really pointed out that the system isn't perfect. So credit, while it works, doesn't work to the way that it should. So, for example, income and employment is now the big question. And you might have a perfect credit score, but if you're unemployed, no one's going to write you a loan right now. And believe it or not, with all the innovation that we have in the U.S., with all the technology that we have, with the size of the banks and the profits of the banks, that's actually a question that still goes unanswered for the most part. It's actually a hard thing to solve, because there is no centralized area where you can determine who do you work for and like what is your income. Income, for example, is actually not a data element that most companies or anyone really knows. So point being that there's still a lot of innovation in the space, and I think there's a lot of opportunity to fix it. So I think that's kind of the thing that I see. But I think the other area is that the economic disparity becomes really into focus when you look at sort of haves and have-nots in the economy. And what we focus on at Credit Karma is realizing that, yeah, the 1% are generally fine, but the 99 get further and further behind because they don't actually have the same resources. And maybe a note to everyone here is, to the extent that, a little bit of my soapbox is, to the extent that we can fix that, I think it's fundamentally important. I think, social economic disparity over time really becomes a drag on the economy. And, I think those are things that entrepreneurs, founders can really address in the next iteration of technology, is to try to, bridge those areas. And it's something that we focus a lot. And maybe going back to your original question is that, I think that it's the people who are, sort of least prepared, or who are falling further behind in COVID. And I think that is going to be a rally cry, but that's also the opportunity in this space, is how do you build a better product for that group? How do you build a product that is less predatory, that is more about helping that group? And in so doing, you can build an amazing business. And you can really, I think, do something meaningful and impactful. And I think that's really important.
Yeah, I know you've also mentioned a few times, I think in some other talks, that just the like what you're mentioning, the consumer empowerment is critical. And I guess as it relates to financial data, a lot of consumers just don't have a good understanding of that, or that plus the fact that just from personal finance perspective, it is quite fragile, more than we realize, and nothing better than a global pandemic to shine a light on that. I guess, and I think you mentioned that those who can better prepare now will be better off, when things, reach some sort of new normal and maybe get on their feet more quickly. Thus, kind of the encouragement of consumers being proactive. I guess, like, how, from the consumer perspective, and this is important, I think, to share, so that founders and entrepreneurs who are trying to build products to help serve these, that they just really understand that, like, how should they be preparing, or like what should they be thinking about, especially when they just they don't know, like they just don't have that visibility.
Yeah, I think the key here is solve a consumer problem, and I share this with a lot of entrepreneurs, and I think that through my own self-reflection, my own experiences, and I think you gravitate towards, and I think maybe many entrepreneurs, and I'm all guilty of myself, you try to solve sort of like you're trying to solve a math equation. I think that's actually the wrong approach. I think the key to at least building a consumer product is to focus on solving a consumer problem, right? So, for example, for us, there's a lot of nuance in the way that we think about, well, we have Credit Karma, we have the consumer, we have the lender, we have the credit bureau. How do you make all these things work, and how do you optimize, and what's your objective function? And sort of one way to do it is like, oh, it's a big math equation, and you try to solve all these pieces at once. That's really hard to do because you don't know what you're actually optimizing for. And what really worked for us is we said, hey, what's the consumer problem here that we're trying to solve, right? And we continually focus on that from an opportunity, from a narrative, from a how you build product. So, for example, we said, hey, credit is really hard in America, and there are three things that we really want to solve structurally. And these are consumer problems, and we want to go and fix it from a consumer perspective. And they've led to all of our product innovation in many ways. So we said, hey, you never know what products you're qualified for. We think that sucks. We think all these applications are ridiculous. Like, it's 40 questions, and if you want to go and apply at a different bank, you actually have to go and apply at a different bank and fill out the same 40 questions again. And there's no way to compare any of these rates or any of these terms because you actually don't know what you get until you actually apply. So, that was our North Star. Those are the problems that we wanted to solve. And, I think that's what you have to do is think about it from a lens of what is the thing that you're trying to solve, and be very clear about that, and don't waver from it. And we focused on solving consumer problems. That was our North Star. We said we're going to go and try to figure out how to make this work for every consumer on our platform. And along the way, you have to think about your banking partners. You have to think about the bureaus. You have to think about all these other considerations. But it's really hard to optimize on that many dimensions, so you have to focus on one. And for us, it's always going to be what's the consumer problem here that we're trying to solve? Not the business model that we're trying to solve, not the revenue stream models you're going to try to solve, not the engagement problem you're trying to solve, but like, what are you going to do for your member? What's the value that you add? And everything for us stemmed from that.
Yeah, I think that, yeah, definitely the focus on, I like the analogy of it's not a math problem. At the end of the day, it's actual human beings that are using your product, and you really need to have, one, you actually have to care about that problem and care about those people. But even it's not a set it and forget it. Like, even to this day, consumer needs change. And I'm curious, like, how the company, and even maybe yourself personally, like, how do you keep that as top of mind in terms of the day-to-day? Like, is it constant outreach to your users and your customers? And how do you maintain that? How have you maintained, I think, that trust in the brand, especially now?
Yeah, and I think this actually goes a lot back to, again, the leadership team, the founder, a lot of the culture, right? The culture is how you share and care for one another, but it also is the institution of the principles and what do you believe in from a values perspective and how that permeates throughout the organization. So we've always had a focus on that, and I think you have to start this really early. And I think, for us as a company, culturally, we know what our North Star is. In every onboard, and I try to do as many as I can. I used to do all of them. It's become a little harder, but I actually get up and talk a lot about our visions and values and what is our, what are we trying to do in this space. And I think it's just important as a level set of here is our North Star. Here's what we're trying to do in this space. And, from day one, you hear that, and it helps set the tone. So, we know we're never going to build a product that is disadvantageous for our overall membership base. And, it starts with that first onboard. So I think that's how you have to do it, and that's how we continue to maintain it. And for me, this is like a deeply personal thing in the sense that, I'm first generation immigrant, really lower middle class upbringing, and a lot of opportunity and a lot of luck along the way. But, in terms of staying grounded, I mean, I've lived it for a good part of my life. And, that's why the impact is so important. And, maybe that's another note for founders is build products and things that you can be really passionate about. There's a lot of business models out there that you can pursue, and there's a lot of really interesting opportunities. And some of those are great. And I'm sure a lot of people have made a lot of money pursuing those. But I think when you can find the combination of a passion and an opportunity in terms of business, that's where you really excel and where you can really make a difference. And it'll be something that you'll want to get out of bed for every morning, not because to make a paycheck, but to make a difference. And when that difference can then also lead into a paycheck, I mean, I think that to me is the trifecta of doing it right. And, I think if you can find that, I think you're going to be in a much better spot.
Right. And I think you're mentioning your being from an immigrant family and immigrant yourself. I remember you wrote a really great post, I think a couple of years ago about, it was called We Are All Dreamers. And you shared your own experience as an immigrant and belief that the diversity and Credit Karma's team is a reason for the success. And I'm actually curious, specifically around, what we're seeing in terms of COVID's impact. And I'm curious, like, reflecting back on that post and kind of what was going on at the time in terms of our administration and policies, like, do you see COVID having, like, what sort of impact do you see it having potentially on immigration policy for this country? But even beyond policy, just globalization overall. Obviously, us as a global firm, it's something that we're seeing around the world, and just anticipating what is that, how is that going to play out in terms of, certainly something as, is obvious as travel restrictions, but also like people wanting to, interact and do more business globally. Or, but yeah, I'm curious to see what your perspective is on that.
Yeah, I mean, at a high level, I think we've seen a lot of the changes from an immigration perspective, and I think as a context of health, and maybe those are okay in the short term. I think we have to be very guarded about how we do it. I think if we're like, hey, we really have to go and be careful of people coming in from hot spots, and we just have to be more mindful, for some period of time. I think that's reasonable. Maybe I'll just kind of expand out a little bit more. Just to me, and I actually had a conversation with our D&I team. I think COVID is a reminder of how easy it is to fall back into racism and why we have to go and stand against it, right? And let's talk about it from that sort of an Asian American perspective. Asian Americans historically are sort of I think less impacted by racism in general. And I know it's a very broad statement. I'm sure some people will take offense to that in some form or another. But my note is like, we're the minority that kind of gets along, and no one, like, you're a hard worker and you're good at math and you're engineering, all the general stereotypes. And as soon as this comes along, all of those things get shattered. Right now, all of a sudden, sort of, Asian racism comes back to the forefront. And to me, it's just a constant reminder of why racism in any form is bad. And that's why you have to stand anytime. And sort of why diversity and standing together around hate in general is important, because it just takes one moment. And I'm always reminded by the poem, first they came for the, sort of the Turks, and, I didn't say anything because I wasn't a Turk. Then they came for, sort of the whomever, and because I wasn't that. And then they came for me, and there was no one to stand for me. And to me, it's a constant reminder of why it's so important that, one, we, talk about and protect, sort of all genders, all sort of forms of ethnicities, because you're just a moments away from what is happening here. And that to me is, I think the backdrop of the COVID conversation. And, immigration, I'll put in the other category of it's, I think diversity of workforce is important. I think that having really well-formed points of view and experiences, like, I'll give you a very, explicit business example. we try to serve everyone at Credit Karma. But diversity matters in the sense that like you have a lot of really well-paid engineers in the Bay Area, for example, who are like, I don't know, have you ever had a food stamp? Like, have you ever had to go live paycheck to paycheck, right? Have you ever almost been kicked out of your home? And how do you build a product for a consumer base who is experiencing those things if you've never experienced it yourself, right? So that's a perfect example of why diversity of experiences really matters in building things that are relatable, and why, you know, having immigrants and having a lot of different experiences from your team establish great products that can be relatable.
Oh, yeah, that is it's very insightful. Thanks for sharing that. I guess before we, looks like there's a few questions coming in, but before we open it up to Q&A, I think just last question for you is, you know, earlier this year, you know, there's an announcement of Intuit acquiring Credit Karma, and I understand because the transaction, I think, is not totally closed. There's probably only so much you can speak to, but curious just what you know, what is next for the company, at least at this point, in terms of what you're focused on, and how does that potentially change, you know, post acquisition, and anything that you can share?
Yeah. Yeah, so the deal's not expected to close into the second half of the year. You know, regulators go through it. There's a process. That's fine. I'll trust it'll get done. And, you know, I have a lot of belief and faith in the process itself. I think, you know, sort of derivations of the note is, you know, one is, you know, people are like, well, was this something that you're looking for? And I would note that, no, I don't think companies should be built to be sold. I think that those end up in, generally speaking, worse outcomes than when you're sort of truly going after something. And I think where this made sense for us is that, you know, Intuit has a great vision that actually, when it was eerily spooky in the sense that they were, you know, before we actually even got into sort of the sale conversation, it was like what they were trying to do and what we were trying to do was like, wow, we actually cite a lot of the same facts, use the same data points as references, and have a similar goal in terms of what we want to do in terms of helping consumers and focus on the economy. So that was interesting. And ultimately for us, what we do from here and what, you know, the deal was very much around was our ability to continue that mission. And to me, that was really important. You know, I think there are a lot of financial milestones that we hit along the way. And for me, you know, going back to this note of impact is really important, and going after passion projects. And for me, Credit Karma, I always think, is the one opportunity, or maybe the biggest opportunity, that I'll have, you know, to make an impact in the world of doing something good, and hopefully being able to bridge, you know, the people who have the least access. And I always try to think about it as sort of like, you know, what was the younger Ken and my family's experience, and how do I make that just a little bit better, right? If I can make that better for one family, one person, like, I will have felt, you know, a tremendous amount of success. And I think, again, that goes to why passion is so important in what you do. So where from here is, we want to do more of the same. You know, I think the thing that really got me jazzed about the opportunity was like, hey, you'll just be able to do it within the Intuit side, and you'll actually have more resources, and, you know, going back to scale really matters in this industry. And when you're working with banks that are, you know, hundreds of billions of dollars and working with market cap and profitability, like, you have to really bring scale to the equation. So I think those are all opportunities and upside for us. So I want to continue on that journey. I want to continue making an impact, and I'm excited about that.
That's great. All right, so a few questions from the audience, and please, if you're on the Zoom, I think you should be able to submit a question, and there's a lot coming in, so I'll try to go through a few. So it's a question coming in. What do you think are the implications of COVID in the market of credit cards, especially in the generation of new customers for the banks?
Ooh, yeah, you know, there's a lot going on in the space. I'll just kind of ramble off a bunch of facts for you. I actually don't know what to make of it. Well, what I'll make of it is all come back. The timing is the question of when it will come back. But how do you know it'll come back? I mean, you'll know it'll come back. You'll come back because, one, I think the U.S. economy is really predicated on credit, for better or worse. And that in order to have the economy that we have, in order to have, you know, the conveniences that we are as U.S. consumers are used to, that has to be true. And every year, you know, 60 to 80 million credit cards are issued, and sure, in some years it will be lower than that, and others will be higher than that. But point being, a lot of, you know, credit granting is important for the overall economy. What we're also seeing is, you know, it's hard to gauge and know what's going to happen in, I think, let's say 6 to 8 weeks from the crisis. I mean, that's I think where we are. And, you know, this may be the deepest part, maybe it goes a little bit deeper. The point being, when you're kind of in the darkest part of the night, it's hard to remember what the sunlight looks like. And I think it's also hard to project what it will ultimately be. But I do have a lot of conviction that the credit card, industry will be back. I think credit granting will be back. Again, there are, trillions of dollars worth of market cap that are really predicated on it. And the one truism of credit, generally speaking, is if you have a portfolio of credit, what ultimately happens is that your bad credit stays, right? So the people who are going to default, they're not going anywhere. They're going to stay in your books. And the good credit tends to migrate, and they either pay down their balances or they go somewhere else. So the only way to compete in that space is to continually originate new customers that are good customers. So that is another reinforcement point as to why the credit industry will be back. So I would sort of put those 3 or 4 data points out there, and they lead me to the conclusion that, the credit card industry specifically will be back. I don't know if that is, 3 months, 6 months, 12 months, 18 months, but I know that, history has shown that, we're going to be issuing as a society, as an economy, 75 to 100 million credit cards a year. Again, I just don't know when that'll be.
Yeah, I think that answers another question that's on here, which is, what's your perspective on the credit management market for the future? And post-COVID, how does that change? But do you see anything that you would expect to be dramatically different?
Yeah, I think like I said, I think it highlights one of the sort of deficiencies in the marketplace, right? So if you think about it from this perspective, if you were an 800 credit score yesterday, and you're still an 800 credit score today, like that's probably true, and you would be lent to. The one dynamic that has changed is all of a sudden, over a course of 5 or 6 weeks, 26 million, 30 million Americans have gone unemployed. So the question is, if you are part of that, maybe you're no longer credit eligible because your ability to pay has greatly diminished. But if you weren't, that aspect of the lending should continue to go on. And the reason why the credit markets are so frozen is that banks actually can't distinguish between, okay, I know you're still an 800, that's not a point of contention, but your ability to pay is a real point of contention. So my note is that that's a deficiency in the space. And I think there's a real opportunity to understand that and say, well, had I known that, at least we could have kept that cycle of the economy moving forward. And, I think that's a problem in the space that, can be addressed in, who knows, in the next quarter, 2, 3, 4, 5.
Yeah. Okay. Another question here is many recent FinTech innovations have been around infrastructure. So Plaid, Stripe, what do you think are the opportunities in this infrastructure type of innovation?
Yeah. Well, I think you noted this earlier, Christine, was that, a lot of it for a long time was very much payments oriented. I think there's a new play on infrastructure, which is coming out. I know that, I think consumer is still being left out. And so I think there's a lot of great innovation. I think a few things will happen. I think there'll be a lot of consolidation. I think, the market's too fragmented. I think finance is, generally speaking, a, market in the game of scale. And when you get to scale, by the way, like compliance arbitrage, which is like I see a lot of startups doing, like that goes away because at scale, you can't really not do compliance. And I think those things become challenged over time. But maybe my note to shift it a little bit is that, again, I think that a lot of people are focused, for example, payments has actually never really been a consumer problem, right? It's actually people like, hey, I don't like paying 3 points of interchange. I want to go and jam 3 points of interchange down to 2.5, 2.25, 2, 1.5, basis points. And I think that's what has happened in that space. And I note that I think the big opportunity is around consumer, in that consumer problems have not gotten meaningfully better from a financial services perspective over the course of the last 30 years, like interchange, like digital payments, and so on. So I think that's going to be the trend of the future, is that, I think there's going to be a realization that consumers are going to be outraged by the services that they're seeing. And we're starting to see a little bit of that, right? We're seeing sort of the Chimes, the Stashes, the Eggcorns. We're starting to see more and more of a focus on building great products for consumers. And I think that'll be the shift that we see over the next 5 years. So I think the infrastructure stuff is great. but I tend to think that is still missing out on where the biggest opportunity is.
Got it. There's a couple questions that are kind of asking the same, so I'll merge them. But it's around how did Credit Karma get its first users? So first 5,000 users, but even also on the larger corporate side, on how did you get kind of your first big corporate partners or clients, especially when you're a startup?
Yeah, this is a little bit of a longer story, but I think it's a fun one. I love telling it. So we worked for about a year and a half on the product. I remember finally taking a vacation after a year. I went to Thailand for the first time with my then fiance, now wife. And I remember getting a call from Nicole and saying, hey, the American Banker just wrote this article about us, and it was without sort of preparation. We were just in the beta period. It was friends and family. I had a friends and family code. And I remember saying, whatever. I'm like literally on a beach in Thailand having a great time. So I'm like, whatever. Like what's the American Banker who actually reads that? So a few days later, I land back in the U.S. and I remember that back in the day, we used to get an email for every registration that we got, because we got like 10 a day, right? So like sending you an email to say somebody registered is kind of cool and it's fun. And I remember my phone had been off for about 18 hours because, I was on a plane. I remember landing at LAX and turning on my phone, and it was like literally like incoming messages for about 10 minutes, right? And what had happened was someone had put that code that we had sent out. It got to the front page of Slick Deals, which was a byproduct of the American Banker article. And it made it to the homepage of Slick Deals. And over the course of that day and a half, we registered about 6,000 people from 30 on average to about 6,000. And I think it was 4,000 the next day. And that was really a little bit of our start. And what it did was it showed me really the power of viral marketing, sort of the power of building a great product. And that's what we really leaned into. And I spent a lot of time with a lot of PR, a lot of outreach. And you have to keep in mind, like, one, we had no revenue per user. And we're competing in this space where, the freecreditreports.com of the world are like literally spending $1 billion on marketing and television with the catchy pirates. And most of the people on this call are probably too young to remember this from the 2000s. But needless to say, a lot of marketing dollars, a lot of value per user, LTV, and the user, and you just had to be scrappy. So, we spent a lot on sort of PR, the organic aspect of it. I remember one of my goals in the first like 2 months of launch was every day at the end of the day is that I would write roughly 20 bloggers, right, financial bloggers, and I would read their articles. I would write them a personal note, like referencing some of the articles. And it didn't take that long, but it wasn't a mail merge, right? It was really like, hey, I really liked your article about X, and I want to introduce myself, and I just want you to try this product. It's really free. You know how to contact me if it sucks. And by the way, write about it if it sucks, or write about it if it's good. So that was our early days, and I think that's, that's sort of the scrappy tenacity, grit that you have to have, I think, when you're running a startup. You can't expect the front page of Wall Street Journal. You can't expect to have millions of dollars in marketing. You have to do these little things. And by the way, read those comments. I think a lot of people shy away from the user feedback. I got involved in those forums. So Slick Deals is a forum. And I remember jumping in there, CK founder, and I'm like, all right, lay it on me. Like, give me the good, the bad, and the ugly, and I'll have a conversation with you. And very quickly, I realized that a lot of people are going to be like, hey, you're going to sell my information. I was like, I'm not. But it was a great reminder of what was on the minds and the fears of our membership base. And it was amazing feedback. It's like a cheap focus group that will tell you things that you will never realize in any other focus groups. So stuff like that, I think, are inordinately valuable. So don't be afraid to engage with your customers. Like people who are like, I'm not walking into the lion's den of whatever feedback. Don't do that. Like, it's amazing for you. You can't pay for that type of feedback, and it sucks. You have to grow a thick skin, and it hurts when people say things about you and about what you're going to do, and question your integrity. But that cynicism, that's really what's on the minds of consumers, and to hear it and to face it head on, really valuable.
Do you still make appearances on Slick Deal forums? Or
not Slick Deal anymore. I used to do a lot of AMAs on Reddit, and I still like to. It's just kind of harder these days, just because all of the legal stuff. I'm like, wait a minute, can I really not say that? And I try not to go too far on like the things you can't say and can't say. I try to be very upfront and not to lean into it, but the reality is just all these kind of like completing things.
Nice. All right. I think we have time for one more question. I'll try to pick something that's not related to credit scores, but well, what are your favorite productivity tools for work and personal use?
Oh gosh. I don't really have that many. I always talk about this is a weird one in terms of like I think of rather than sort of traditional way of thinking, I think a little bit about procrastination and like there's a million things that you can do, and I like this theme, and it's probably very counterintuitive. I like procrastination as my optimization function because like it really shows you what's important in the moment. Like when you're down, as a CEO, as a founder, there are 1,000 things you can do. There's a million things that you can do. And I think to me, what I learned over the years is that you can't do them all. The marginal value of most of them are actually quite low. And I think the sanity and the perspective that you have is way more valuable. And I like to use procrastination as a good litmus test of like what is really important, because of what I found over the years, like you really get the stuff done that is important. And realizing that and thinking about that is something that you miss. You always think that, success is working 90 hours a week, 100 hours a week, and that's true, it is. But part of that is actually filtering out which pieces, and that prioritization is really important. And so rather than the tool, I like to think about the process of what is important. Don't try to do everything. Do what you're good at, do what's important, rather than trying to do everything. And I think that is the most important productivity construct.
Yeah. I use Post-its.
Yeah. I have my notebook here, and I still kind of use it old fashioned, like write it down and, star and asterisk stuff that really has to get done. You'd be surprised at what that does.
Exactly. All right. I will there's one really good question that came in, and this will be the last one because we're close to time, but like last note for everyone listening, because it's a common topic that's easy to say and hard to practice, but what tips do you have for founders on just staying resilient especially during this time where there's so much uncertainty and it's very draining on people just with everything going on?
Yeah. I think the note that it's lonely at the top is very true. I think that as founders and CEOs and in these times, the companies tend to get their cues from you. And I think your ability to stay positive, your ability to stay optimistic, but also move with drive, with speed, with grit, with tenacity, those are all really important. I think with that said, it's hard, right? In this type of economic environment, where, I think I personally had a couple of weeks where I felt like it was like 4 weeks worth of bad news. Every meeting, every phone call was just like bad news around the economy, around what was going on. And I think the thing to recognize there is find an outlet, find a group, find a set of people who are not business oriented that you can confide in. So whether that be YPO, whether that be someone on your board, whether that be just a very close friend, there is a lot of relatability in the experiences that you have to go through, and they're hard. And I think your ability to have a sounding board, someone to talk about, and sometimes just saying things is just amazingly freeing, right? And saying things in a group of people who don't maybe know your business or aren't going to judge you, I found that to be a really great help. And I think we often think too much about like, you just have to do these things on your own. And I don't think that's true. So I would suggest everyone find their sounding board, their confidant, their mentor, just their peer that they can talk to, because it's hard sometimes within your own organization.
That's great. All right. Well, thank you so much, Ken, for the time, and thanks for all of you who joined us here today. Ken, what's the best way for people to stay in the know on Credit Karma?
That's a good question. I mean, I don't know, actually. I mean, I think, we have a lot of communication streams, whether it be social blogs and so on. But if anyone has, specific areas that I can help on, I think they know how to reach out, and whether through you or something, we'll find a way to connect. But we're out there.
Okay. Most likely go to creditkarma.com. You'll find.
Yeah, Twitter, Facebook, or it's sort of, that's where all the products at. But, for everyone on the call, feel free to reach out, and, happy to jump in a quick conversation.
Okay, awesome. And then on the 500 side, for those of you who want to be in the know for future webinars like this one, make sure to fill out the form that's going to pop up when you close out of this Zoom. But all right, well, thank you so much, Ken. Thanks everyone. Stay healthy, and we'll see you again.
Thank you.